Welcome to TheoTrade. This is Don Kaufman, July 15th, 2020. Minutes to go to the cash close here on a Wednesday afternoon. We are tuned in, turned on, looking at the Nasdaq futures here, which people, if you have not looked at any of the intraday trade that has occurred, well, in the last couple of sessions, specifically in the Nasdaq, you're missing the bigger picture of this entire marketplace because the Nasdaq, it's just downshifted completely into ludicrous mode. I mean, this thing has become Mr. Toad's wild ride. What I'm actually referencing are individual minutes. In fact, what you're looking at right now, and I'll go into quite some detail on this, but this is a 5-day, 1 minute. Again, we only have about 8 minutes left inside of the trading session, but you can see it precisely what I'm referencing. I mean, listen, this is a 1 minute candle that just passed us by over here. Oh, don't worry. That was good for 30 Nasdaq candles. And that's nothing. We are seeing wild bids. Then we're seeing the Nasdaq turn into the bidless beast. I want you to recognize, though, that it's one of the hallmarks of volatility and a larger move that's ultimately underway inside of the broader marketplace. In fact, a lot of these, what I kind of term Mr. Toad's wild ride, some of these moves really appeared like all the way, again, about 5 days ago, back to last Thursday. And again, I'm just backing you up in time. Here is the Nasdaq, obviously, in yesterday's trading session. Just hideous intraday moves. And we love it. And it continues on. Again, we can go back in time here a few more days. This is the Nasdaq going bidless into the close. And again, over the last 5 trading sessions, it has been downright wicked inside of the Nasdaq itself. Net, though, one of the things that I do want to point out is if you look at a 30-day 1 hour, and again, it's so rare that I spend this much time on an index product, and even more appropriately, I'm spending time on the futures contracts that maybe you don't even necessarily trade. It's okay. You got to understand that what's going on in the Nasdaq right now, this is what is driving flow to the entire marketplace. And I can't even stress it enough. Like, literally, we're watching the marketplace with a few seconds to go, if you will, to the cash close. The Nasdaq, it'll be ticking in, 25-cent increments. The next thing, it's actually moving $3, $4, $5, okay, every single tick. It's just, again, this is what's driving order flow to the broader marketplace. We're also seeing, which I'm going to cover here in a moment, some really wicked and fast capital rotations. But again, kind of backing out a little bit in time over here, what you happen to be looking at, this is a 30-day 1 hour. And from last week to right now, we had to go all over the place to get absolutely nowhere. But when I'm talking about, the Nasdaq getting all kinds of wild, I mean, we are seeing 500 and 600 point moves inside of the NQ, again, on an intraday basis. So where does this actually leave us? One of the things that I want to examine here as we do come into the cash close, and one of the things that I put a tremendous amount of weight in, is if we take a look, okay, at what we term the convergence and divergence of major index product, this is actually going to speak volumes. And what I'm actually referencing, and I give you a little bit of an overview before I dive too deeply into it, what I'm actually referencing, it's the capital rotation, okay, specifically today. They're rushing into the Russell. You got to realize, and I'll show you a better way to actually look at the Russell, is probably the IWM. You have to realize to this point on the year, okay, no one has wanted to touch the Russell. I mean, the Russell has been, for the most part, like tainted goods, down about 11% on a year-to-date basis. Whereas if you took a look at something like the Nasdaq, the QQQ, that is actually up, about 20% year-to-date, which is just mind-boggling. Well, in the last couple of trading sessions, they're converging upon one another. And they're converging upon one another in a very, very fast manner. And what that effectively means is the QQQ is either sold off, okay, or held steady. And the Russell is actually ripping back to the upside. And I think one of the best ways to probably display this to you is to do just that. We're actually going to use a comparison chart. I'm going to come down over here to load style. And I've got a comparison chart all ready to go. All right. So what we're looking at here with just seconds to go to the cash close, all right, this is exactly what I'm referencing. Just the other day, the Russell's actually down some 16, 17%. It has actually got a monstrous bid into it. Meanwhile, you've actually got the Nasdaq coming off over here. What's unusual about this is a convergence of this magnitude, all right, between two index products. And when I say a convergence, again, literally, all right, they're pulling towards one another. The convergence of this magnitude is, prototypically during fits of sell-side activity. Huge volatility in the marketplace is typically what you see when you see a convergence like this. So we are in some very, very uncharted territory right now, as again, there's kind of this wicked capital rotation. And when it comes to the Nasdaq, you simply can't trust it as far as you can throw it. And quite frankly, it's not even the entire Nasdaq that this volatility is coming from. It's, specifically the monsters of tech. This is when you got to start pointing fingers towards Amazon and Google, okay? Microsoft, Apple was actually in that ring a little earlier today and got a bid back under it, and Apple's actually going to close up in the day. But our quote-unquote monsters of tech are the disconcerting area, okay, that are really driving a huge amount of trade. What's even, I think, a little bit more unusual on this particular front is when you start looking at the advanced decline line. There were points in time in the last couple of days, we looked at the advanced decline line. The advanced decline line was absolutely screaming, and yet the S&Ps were getting pulled down. Why? Because, legitimately, we have 5 stocks, okay, that are enough to actually pull the entire market down without necessarily, okay, a negative advanced decline line. In fact, again, we had an advanced decline line that was screaming at one point today that was 90-10 with the S&P slipping to the downside. And that's simply because there was huge sell-side activity, okay, literally, all right, in 2 major Nasdaq stocks. All right, push all of that aside for just a second. Okay, so I looked extensively at the QQQ, and then I thought about the QQQ versus the IWM, and I started looking at this in terms of like auto expected moves. And when I say auto expected moves, I like to look a lot at expected moves to give myself kind of orientation of where we are kind of on the last few weeks of trade. So the IWM specifically has actually cracked outside the expected move in today's trading session. Now, the Nasdaq, the QQQ. I've been talking about this just, repetitively on some of these evening videos that I fully anticipated that the Nasdaq was going to pull back. At this point, we've had a decent pullback. Again, there was follow through and a breach of the expected move 2 consecutive weeks. We were looking for a wicked pullback. We got some degree of a pullback, a little bit more of a pullback on Tuesday, but ended up just north, of course, the expected move. I don't necessarily believe that move is per se over. But there are, at this point in time, there are much better ways to trade the Nasdaq than just let's get purely bullish or bearish. Let me show you one nice area, okay, that I don't think a lot of people are necessarily familiar with, okay, or looking for. And that has everything to do with what we term implied volatility. All right, so one of the things I want you guys to see, if I cruise over here to studies, I'm actually going to drop down to add a study. We're going to actually cruise all the way up to implied volatility. Why? I just want you to visually see implied volatility on the screen. We're going to zoom out just so you can see it a little bit. There's the closing bell. So the implied volatility here inside of the QQQ has dropped off quite substantially, all right, since the Corona crash. So that was actually the peak of the crash. Of course, the volatility peaking out, and the volatility has come off substantially. Okay, that's the QQQ. Then we'll actually take a quick glance over at the IWM. IWM. Interestingly enough, the Russell maintains an extraordinarily high volatility. Even though the Russell has rallied out, the Russell hasn't rallied nearly as much, of course, as the Nasdaq, or if you will, and last but not least, we're going to take a quick glance at the spiders. One of the craziest divergences that we've ever seen. Forget about directional bias of the spiders, or forget about directional bias of the IWM or the QQQ. Their volatilities are all over the place. We've actually got products here, index products, okay, where one, we could turn around and start selling options premium. The other, we can actually turn around and start buying options premium. You're like, I don't get it. Let me see. Okay, this has everything to do with what we call IV ranking. Again, IV ranking. So I'm actually going to snap to what's called, this is an implied volatility range I'm going to show you. What this implied volatility range is doing, okay, it's kind of ranking in effect, implied volatility right here in the spiders. Now, some of you may or may not be familiar with this idea of like IV rank, but when it comes down to IV rank, if you're on the thinkorswim platform, you can actually cruise down right here under option statistics. And under option statistics, what it gives you is it gives you a 52-week high for implied volatility and a 52-week low for implied volatility. And then it ranks it. And right now, the spiders are ranked, okay, the 23rd kind of percentile. All right, what does that mean? Okay, it kind of means they're in their lower end of the spectrum of volatility. And a better way, I think, to represent that is to actually look at the chart, because what we did is we actually took that ranking and put it specifically into a chart. You could say, look, right now, right here, right now, we're kind of at a lower instance of implied volatility, okay, than at any other point since the onset of the whole Corona crash, right? So the volatility is low relative, all right, of course, to the SPY since, again, the onset of the Corona. All right. The next thing I wanted to point out is if you start looking at the QQQ, it's a very different animal. Okay. The Qs, in terms of an IV, okay, ranking, they're at 34%. So they're considerably higher. And then it gets even better because the divergence today inside of the IWM, okay, the IWM is still rocking. And that thing's like middle of the road, 39th kind of percentile when you start to look at it. So what we're going to set up in the coming days here, and it gets a little complicated, a little wild. We're actually going to look at some strategies onto which we're going to be selling options premium in one of the major kind of ETFs, buying options premium in another major ETF. And again, we're going to look actually for convergence of the implied volatility. In places that we're going to buy the options, we're hoping implied volatility is going to increase. In places we're going to be selling the options, hopefully they're going to converge upon one another. People, this is non-directional trading at its best. I know you thought I was going to come in here, get long, get short. Nothing of the kind. The implied volatility is where you want to be right now. And again, the Nasdaq, with all due respect, is throwing off just all kinds of wicked signs that there is a tremendous amount more in terms of volatility to come. A lot of opportunities inside of this marketplace. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.